Welcome back, everyone, to this week's episode of the stocks I'm buying in my Dividend Snowball portfolio. I hope you've had a great week. Let's jump right in. As always, not investment advice. Do your own due diligence. What I've got this week is three stocks, and I've got some comments and some charts. The first stock I bought is I added 2 shares of Alaris. I've spoke a little bit about it in both of the last two videos. The buffer has been buffer. When I say buffer, I mean the buffer discount to NAV has been shrinking pretty quickly. I'm kind of surprised. I don't know why I guess a lot of things have been rallying, but the buffer is shrinking. So I've already kind of established a position here. Um, if it keeps going up, I'll probably add some other stuff as a number of things on my list. I think there's a few things I would be a bit cautious of in the short term. I still like the stock. Obviously, I bought a bit more. The earnings last quarter, they mentioned that they benefited from FX. So the rising US dollar was a benefit. That might pull back a little bit in the near term. So, the discount will probably continue, but I think heading into the quarter, that could be something that gives back a little, but still, if the stock keeps executing, should be fine. What I've also got on Alaris is I just was looking the other day at the historic multiples, and we go back to 15 years here, and you can see that in the past, it traded up to almost 3 times book and almost 15 times EV to EBITDA. So it's still a substantial discount off of the highs in valuation. Now, I'm not counting on it getting back to there, but I was just mentioned a few weeks ago that I thought it's probably worth a premium to book. And while it hasn't been there for a while, it, it used to regularly trade there. And when it was trading there, it the performance recently has been better than when it was trading at its higher valuation. So I'm not saying it's going there. I don't think it is, but I'm just saying I think there's valuation buffer in the name. The next stock I bought 1 share of GoEasy. Now, I'm not turning into a alternative lender fan here, but I don't know. It hit my thresholds, I guess I could say. So Go Easy has a decent dividend yield, 3 point something percent, and that's a pretty low payout ratio, also at about 25%. And when I do the math on it, if I figure okay, something like a 25% return on equity, and if that's 1/4 dividend, 3/4 growth, that they could still put up high teens, 18% growth if they put up those numbers, um, and plus the dividend, which is hits all the thresholds that I have for this account. Now, my what I would also say is that with all of these types of high return on equity things, I do like to build in some potential derating because as the company grows, the incremental return on invested capital probably trends lower. And this is the same thing that I would say for Propel. So you can't just necessarily do the math and be like, okay, 25% return on equity is 18% growth and 3 and plus whatever dividend forever, because then your IRR would work forever when it might not, because eventually the return on equity will probably trail back towards something more average, and the growth will slow. And if you're stuck with a high valuation when that happens, that's not good. But on terms of valuation, when I look at Go Easy, in the past decade, most of it's been between 2 and 3 times book. And currently, it's trading at about 2.1 times book. So again, towards the lower end of the range. And book has done fairly well. As you can see at the bottom, they keep growing their book value. And that's really what you're looking for. So, again, one share. I'm talking like I love the thing, but no, it takes a while to build a position, and I just bought the first share in this account. The third stock is I bought more Propel, and I don't know why it's up so much, to be honest. I was definitely hoping to get a bigger position before it moved, and that doesn't seem to be working. Uh, like I said, for Go Easy, it looks like they're targeting something like a 25% payout ratio, and they have a also have a very high return on equity. Plus, they have a component of the business that is capital light, the lending as a service. If they can get that to grow, the return on equity could, you know, trail even higher because services business don't really trade off return on equity. On the other hand, unlike Go Easy, this one, the price to book multiple is higher. Now it's lower than it was before, but it makes it hard to say to do the math of return on equity equals this much growth and this much dividend. Because again, with the high return on equity, I want to build in some D rate, which makes it less secure when I'm looking at trying to nail down what IRR I'm getting. Same thing with when you look at how the return on equity will swing between, it might swing by 7% between the top and the bottom end of the range or whatever, whichever number you want to use. It really makes it hard to know what you're going to get. Now, I think they could have a decent runway for growth, so I think that I give it a bit more leeway on the valuation, but still, I want to build in a D rate over time, and so I don't want to pay just any price. And on the valuation on this one, again, it's hard to necessarily say because it doesn't have much of a track record. It's a newer stock. It hasn't been around for a while. Um, but still the revenue growth is basically all I can say. The return on equity, as you could see, kind of when it was a new company, it was low because of, you know, new company and fees and the turn of the cycle. And then recently it has gone really high and now it's back somewhere in the middle. So it's, there's not enough data to be to really use it. So I don't want to harp on this, but I think that it still has good days ahead. But again, with my 9 shares, I'm not like, I'd prefer it goes lower to maybe build an actual position rather than be like, yay, I've got 9 shares, you know. And yeah, that's it for the stocks, but what I was going to say is a few portfolio notes. One is that I'm kind of working towards trying to figure out a concept of what I want for the portfolio. So, like, I have I'm working on a spreadsheet where it's like, okay, I want to get to 1% of this, 5% of this, and so I'm still figuring that out. But again, so with this account, uh, those are longer term goals. I deploy, looks like about 15% of the capital in this account per year. So it would take about 4 weeks to build a 1% position if I was just building one at a time. And obviously, with Propel and Go Easy or Greasy, um, that's 2 positions at a time. So it's, would be 8 weeks, except there's other stuff too. So basically, normally I'd and then normally I would prefer 5+% positions, maybe not with both, maybe not with either, but this account is going to be more diversified. So I'm using the fact that it's going to be more diversified to have smaller, you know, to buy some stocks that would fit as smaller positions. And again, the plan is to dilute the size of the current positions by adding new ones, but hopefully they won't let me. But that is all I have for today, and I want to thank everyone for watching. And if you have any ideas of something that would fit in this portfolio, I'd love to hear them. And aside from that, have a great day.